Hello traders, you're welcome to this video and I will welcome you back to the Forex Geek channel. In this particular video, we are going to be diving deep into the RSI Reversal Strategy, okay? A proven method to identify trend reversals in the market, all right? So the Relative Strength Index is one of the most widely used indicators in technical analysis, all right? And when applied to reversal strategies, it can help you to catch market turnarounds with precision. Now, the RSI reversal strategy actually focuses on spotting when the market's momentum is about to shift. Okay, this strategy is quite effective, although it does not guarantee profit. All right, it does not guarantee profit. Okay, so before we dive into the RSI reversal strategy, let's quickly review what the RSI is. Okay, it's a momentum oscillator that measures the speed and change of price movements and is plotted on a scale of 0 to 100. All right, and the general rule of thumb is that an RSI above 70 is considered overbought, and an RSI below 30 is considered oversold. Now, overbought and oversold conditions often indicate that a price move is reaching extremes. For example, we can see here when we had an overbought condition, you can see that the price of the assets was about to reverse. Okay, and you can see in this case when we had an oversold condition, you can see that the price of the asset was about to reverse as well. Okay, all right. So how do we use the RSI to catch trend reversals? The key idea behind the RSI reversal strategy is that when the RSI reaches overbought or oversold conditions, it often signals that the current trend is losing momentum and could be about to reverse. Okay, for example, if the RSI moves above the 70 level, it's an indication that the market might be overbought and could be ready for a downward reversal. And you can see that that exactly happened here. Okay, on the flip side, if the RSI drops below 30, it suggests that the market could be oversold, potentially setting up a bullish reversal, and you can see that that happened here. But here's the important part. We don't just blindly take positions whenever the RSI crosses these thresholds, right? The strategy is about confirming these signals and waiting for the right moment to enter. This is where the magic happens in trading, waiting for confirmation before acting. All right, now let us talk about how you can apply the RSI reversal strategy to your trading. We're going to start with an example on a chart, right? As we can see, imagine if you are trying to find a good trading opportunity. This is the GBP JPY currency pair, right? And then you see the RSI reach as a level above 70. The first thing you want to do is look for signs that the current bullish momentum is losing strength, and this could include price action patterns like candlestick reversals or price stalling at resistant levels. And you can see there is actually a resistant level around here. All right, we can see that. Let us zoom out a bit. Okay, let's zoom out a bit. We have a resistance zone around that point. And apart from the fact that there is a resistance zone around that point, if you look closely, you're going to see that we had a bearish engulfing. Can you see this, how this candle swallowed the previous? So when you notice any reversal patterns around the resistance or at the time the RSI enters overbought and dropping below the 70 level, it could be a confirmation to enter a sell. On the other hand, if the RSI falls below 30, indicating oversold conditions, look for signs that the market is ready to turn up, like a bullish engulfing that happened here. It was a sign, it was a confirmation of the buy. So once you have confirmation, you can enter a long position expecting a bullish reversal. And you can see that that happened here. Now, as you know, no strategy should rely on just one indicator. All right. So the RSI reversal strategy can be even more effective when combined with other indicators for confirmation. Okay. So one of the indicators you can use is moving averages, but you may not necessarily need to use a moving average. You can actually use any other indicator of your choice. But the main thing is ensure you get a confirmation. all right, ensure you always get a confirmation, right? For example, if you decide to use a moving average for your confirmation tool, whenever you get a sell signal, make sure that you also confirm the signal by waiting for price to drop below the moving average. And when you get a buy signal, ensure you wait for price to cross above the moving average, for confirmations. While the RSI reversal strategy is effective, risk management is critical. Okay, you always want to have a plan in place to protect your capital. A good rule of thumb is to use stop loss orders to limit potential losses. For example, if you enter a short position after the RSI signals an overbought condition, you could place your stop loss just above the most recent swing high. All right, just above the most recent swing high. And if the market doesn't reverse as expected and continues its upward move, the stop loss will automatically close your position at a predefined level, minimizing your loss. All right? Also, make sure you are trading in line with the overall market trend. For example, don't try to trade against a strong trend without solid confirmation. We can see that in this scenario, we had a breakout. This was initially a bullish trend, but we had a valid breakout here. And after the breakout, we had a retest. That retest confirmed, the retest and the continuation confirmed this new sell move. Okay? So like any strategy, the RSI reversal strategy has its pitfalls. One common mistake traders make is acting too quickly. When the RSI hits the overbought or oversold zones, it's easy to get excited and jump into a trade. But remember, just because the RSI is in extreme territory doesn't automatically mean a reversal is about to happen. Okay, so always wait for confirmation before entering your trade. Another pitfall is failing to use proper risk management. The RSI can sometimes give false signals, especially in volatile market conditions. So always use your stop loss orders and make sure you are trading with proper position sizing to avoid large losses. Now, there are times when the RSI reversal strategy isn't the best strategy to use. For example, during strong trending markets, the RSI may stay in the overbought or oversold zone for long periods of time, giving you false reversal signals. So in these cases, it might be better to use a trend following strategy instead. Okay? Another time to be cautious is during periods of high market volatility or news events. This can cause sharp, unpredictable moves that may distort the RSI's readings. It's best to stay out of the market during these times or use additional filters to reduce risk. To wrap up, the RSI reversal strategy is a great way to spot potential trend reversals in the market. By combining the RSI with other indicators and using price action for confirmation, you can catch market turnarounds with more precision. But like all strategies, it's important to apply sound risk management to protect your capital and stay disciplined. If you found this video helpful, make sure to hit the like button, subscribe, and leave a comment below with your thoughts or questions. Thank you for watching, and I'll see you in the next video.